Good afternoon, everyone. In today's video, I'm going to be focusing in on the S&P 500 for at least the first half of this video, before then switching to intraday volatility, where we'll take a look at the four major index markets to see which market was really driving the volatility today. Now, starting off first with the S&P 500, I find today's move significant since we finally hit that 1272 extension that we've been looking at now for quite some time. We thought this extension would be hit really starting this point, where we had our first scare where we thought we'd break that 1618. We of course bounced from there, then we continued to keep breaking below. Again, thought that 1272 would come into play right here, bounced right back to the 1618 before finally over the course of 1, 2, 3, and 4 days have really just made this entire move. Now up here, we created that SPY butterfly with a downside target of 400. We've of course well overshot that, so we'll take a look at that butterfly as well to see what's happening there. Now first, if we just focus at this on this chart, this is our Fibonacci retracement levels using our Feb to March 20 swing high to swing low, and we're now at that 1272, and we have this little gap right above us near that 3900 mark. In terms of what I think is likely to happen next, I think we find a little bit of support here, short-term bounce, maybe fill this gap, before then continuing to make our way down to what would be that 100% retracement mark, which is near 3400. So to me, that's the overall downside target, but I do think we get a little bit of a breather considering this move that we've seen over just 4 days. We've essentially plummeted from that 1618, 4153 down to 3730. So quite a move there. Now, switching next to the butterfly, when we put on this butterfly, that was for a debit of $76. You can see that right here. And we were targeting a downside move at that 400 pin, but we also wanted to protect ourselves in the event that we overshot on the downside. So for that protection, we capped our max gains at 124, where we essentially were risking 76 to try and make 124. Now, as of filming this video, the butterfly is currently trading for $2 credit. We're using some simple arithmetic here. If you take that 200 credit minus the 76 debit paid, we're left with that same max profit we originally had intended or planned this trade around. So we're now at max profit. This trade is essentially at the place where you can close it out. And minus commissions here, this was a nice trade. Of course, knowing that the 4 downside days that we've had, I think we would have structured this trade much more differently. Of course, it would have been more lucrative to just buy a put, honestly, instead of worry about this multi-leg strategy. But not knowing that in the moment, I think this trade for the risk to reward that we got was a fairly nice trade. And hopefully you were able to learn a thing or two, if not actually participate in it. Now moving on next to the intraday volatility, there's 2 different lenses that I'm going to take a look at this with. The first is applying that opening range breakout strategy on the S&P 500 futures to answer the question, is this effective? Has the P&L been positive? And if so, how many winners, how many losers? So we'll take a look at that first. After that, we'll move on to taking a look at the intraday volatility setups we had today, which is where we'll bring in other index markets and try and rank volatility side by side to see which market was driving a majority of the volatility today. Now, starting off first with the opening range breakout strategy on the S&P 500, this is going back 5 days on a 1-minute time frame chart. For all Volatility Box members, I have a link to the opening range breakout backtester in the description box if you'd like to follow along. The settings that I have for the backtester are a breakout. I'm looking for a close above or below the breakout levels. Stop is at the half range mark, and the target is the half range mark as well. Using that on the S&P 500, we've had a total of 4 breakouts in the past 5 days, 1 on the bullish side, 3 on the bearish side, and all 4 have been winners. So I think that's a good sign of the setup working in at least the past recent 5 days. However, if you expand that to 10 days, those same statistics don't follow forward. So I think the important note here is the setup is working, ride it for as long as it does until it stops working. But as soon as it stops working, I think that should be the sign to essentially put your foot off the brakes in the ORB strategy for the S&P 500. Now, using the bias that we have here, knowing that at least both long and short trades have been winners, and we know we have that likely gap fill to the upside, so that would support the long idea, along with just overall bearish activity, and we still have that downside 100%, gives us the ability to play, I think, either one of these breakouts So again, for all Volatility Box members, you can download the Backtester and play along with it. If you don't trade the S&P futures but want to test this on SPY, you can go ahead and apply that on SPY as well. It's really any market inside of Thinkorswim. Now, next up, let's take a look at our intraday volatility using our Volatility Box models. The setup I'll be focusing in on in today's video is our fade setup, which I'll leave a link to, which breaks that setup down in more detail. We also have a trend setup for those that are curious, and I'll leave a link which breaks that one down as well. So two different setups to trade the volatility models. Now, starting off in the S&P 500 here, we had one breach that took place over the course of the day, and that took place in that 7 to 8 a.m. Pacific hour. In the morning, we bounced, we respected our models, and then we fell where price fell into our sign line. We saw 1, 2, and 3 edge signals on that 1 minute time frame chart. So at this point, we know we're now in oversold territory and we're looking for a bounce up in the S&P. We then had a little bit of heat on this trade. It's not like this trade came without heat. Before finally we did still hit T1 when price here reversed, and we had really a nice rally that took place again over the course of 1, 2, 3, 4, and 5 minute bars before you made a move to T1. So that's been the story here. It's been a lot of big candles inside of the S&P that's taking you to some of these targets that we're looking at in a way that I think you have to deal with a bit of heat along the way. So our risk on this trade, 11 points, which was that same first target as well. Second target was 28 points, which is this gray line right here, which we fell short of by just a little bit before the S&P reversed, and the final contracts were taken off at break even. Now, the second breach that took place in the S&P was in that 10 to 11 a.m. Pacific hour, where price broke outside of the scalper. Now here, we did not hit our setup rules before price went outside. We didn't see that red arrow prior to price going out of the clouds, which was then our sign to adapt and switch to this new volatility condition, switching to the aggressive Volatility Box models. Now, before we switch to that, let me show you what that 7 to 8 a.m. Pacific hours volatility looked like when this breach actually took place, because I think that's where this becomes interesting. And I took some screenshots when that breach was taking place. So this was the S&P 500. If you take a look here, the S&P, we had a little bit of heat, but from that point, we really had a rally. Now the S&P, the question here is which one of the two markets? Was it the Dow or was it the NASDAQ, which was really bringing the S&P down lower here? If we take a look first at the Dow went outside of the clouds, and for that same fade setup, the Dow was a stop out. Very clearly here, the Dow has downside pressure, selling pressure, and it's the one driving the volatility in the S&P. I think that becomes all the more clear where if I switch to a chart of the NASDAQ here, the NASDAQ that same hour, we barely touch even our sign line before bouncing straight up from there. In fact, in this setup on the NASDAQ, we don't even get an opportunity to enter. We don't see our signal or anything before NQ reverses and buyers come straight in, really picking up price action here and taking us to T1. So between the three markets, the S&P, the Dow, and the NASDAQ, the S&P was being pulled down as a result of the Dow's volatility in that 7 to 8 a.m. Pacific hour, which is very easy to see when price goes straight outside of the clouds here. You can also see that in terms of which touches our sign line first. The Dow took place at 7:30, the S&P right around that same time, the NASDAQ here much later, right around 7:45. 15 minutes later do we see similar volatility inside of the NASDAQ. So again, all of these are different signs and hints to help you understand which market was driving the volatility today. And finally, if I show you the Russell, just in case small cap traders are out there, the Russell a little bit more stabilized here. Price hits our sign entry line, we bounce in between, we get our edge signal once and 2 times before price then reverses and hits our T1 without as much heat as say the S&P had, and of course the Dow was a loser. So the Russell, the S&P winners, the Dow a loser, and we can see the difference in volatility there as well. Finally, let me show you how the S&P looked now once you switch over to the aggressive model. So this is after that 10 to 11 a.m. breach, where right here, if you remember, we went outside of the scalper. Using the aggressive model now, we can see the S&P falls inside of the aggressive model in that same hour. We have the edge signal in reverse hitting T1, again, before getting the actual opportunity to try and enter or play any of these moves. Into the close here, we have that rally where showing you how the S&P closed. If I come into that 1 minute ES chart here, into the close, we really just chopped right back to the middle of that volatility box zone. So no volatility edge into the close. Hopefully today's video is helpful for those of you that focus on trading the index markets or even the S&P, or you've been tracking along the S&P on that extension in the first place using our very first Fibonacci swing starting really that March of 2020 point. We've been monitoring this roadmap. We're finally now really retracing our steps here to that 1272, and I think this is an interesting place for some new positions, maybe with some short-term bullish upside, trying to take advantage of any puts that might be, say, overpriced as a result of these past 4 days. All right, hope this video is helpful. Take care, everyone. Good luck trading, and I'll see you in the next update.